Hi everybody, welcome along to today's presentation on COVID-19 and effectively our 6-month review into where things are at and what we have to look at over, I guess, the coming months, but also potentially the years ahead with our self-managed superannuation funds. So thanks very much for joining us. As always with these presentations, if you've got questions as you go along, then please send them through to us. I have with me today, Tom Davies. Tom, welcome along.
Thanks, Tim. Thanks for having me today.
So yeah, as we get some questions coming through, Tom's going to shoot them over to me. He's also one of our senior client managers here at SuperGuardian, and so he's had the opportunity to experience the questions firsthand from our clients, our trustees, and our advisors with regards to a lot of these COVID issues. So looking forward to presenting with Tom today. So what we will do is we'll jump into to the presentation, and I will we'll kick things off. Today, what we're really trying to look for is that you get some takeaways from this. Now, a bit of a reminder that I'll put up at the end of the presentation as well, but just to give you a little bit of a guide as to what I hope you get, and also what we will give to you after attending the presentation. But given that we're so far into the COVID process and the COVID environment that we're currently living in, I've prepared a presentation paper that I want to send out to you afterwards. So I'm going to be talking through a lot of the practical issues today, and that paper will supplement those issues and also give you a few sort of worked examples with regards to rent relief and LRBA relief and a number of those issues. So the paper will be a fairly comprehensive document to support the material. You'll get a copy of the slides, and obviously you'll get your CPD, but we'll also ask you for any feedback from today's presentation. We took on board the feedback we received after the last one, which was all really positive. And so we want to make sure that these presentations are a collaborative event with those attending being a big part of what we're actually doing and providing. So at the end of this, what I want you to get out of it is the capacity to review your client's needs with regards to early release. And I've put this potential tranche 3. So I'm going to touch on what I mean by tranche 3 with regards to early release, because I don't think the need for people digging into their super is necessarily over. Not that I'm necessarily promoting it either, but I think we need to be armed with all of the facts. And so I also want to revisit some stuff that the government have done in this space sort of over recent years. We'll also then reevaluate the current rental agreements your clients might have. Obviously, there will be, in some instances, needs for extensions of rent relief. I mean, particularly if you've got Victorian-based clients who may still be experiencing certain lockdowns and only sort of the bare essentials going into offices. So there might be a lot of vacancies at present. So we need to contemplate the rent relief issues associated with self-managed super, and also what that means moving forward, because the rent relief, if we're doing a deferral, does provide for loans in the SMSF books, and we need to make sure that these are accounted for appropriately. Again, that as I guess a direct follow on from that, communicating the main issues associated with financial assistance and providing financial assistance to members or their relatives, and whether we're providing rent relief or reductions in other sorts of expenses, we've got to contemplate what that actually means in the SMSF space. And so I want to highlight a few of those financial assistance sort of triggers that we've had in the industry for the last sort of 20 odd years, but becoming far more relevant in a COVID environment, given also that self-managed super funds still number one with a bullet, their contraventions is that loans and financial assistance to members. So, this is particularly a key time to make sure that people aren't using their self-managed super funds for the wrong reasons. And then I want to finish off with just a little bit of a summary on effectively our last presentation, which was on lump sum withdrawals and things from the pension accounts, but just to raise a couple of points with regards to what we need to consider as to whether we want to keep pensions going and get our exempt current pension income deduction, or whether or not we should be looking at preserving fund capital, which of course means we're foregoing that exempt pension income, but is it in the client's best interest to potentially stop pensions? And again, like all of these matters, my job here today is not to convince you one way or the other. It's just to work through the thought processes for you to ensure that that your clients are best served in this space. So what we'll start with is how early release could impact your clients well beyond 31st of December this year. What rent relief is fraught with investment restriction traps, or why rent relief is fraught with investment restriction traps, and then that capital preservation versus the income tax exemption. So look, let me jump straight into the presentation to talk a little bit about early release. And look, statistically, it's one of those areas where right now in the SMSF space, based on some presentations given recently by senior figures in the ATO, we know that up until this point, about 19,000 self-managed super funds have made about 35,000 applications for early release. So, you know, those numbers aren't staggeringly high, but they're not inconsequential either. And so it's an area that we need to continually be mindful of. But of course, not all of our clients are SMSF clients, or not all of our SMSF clients have all of their members in the self-managed super fund. And so the early release of super is a far broader issue that we need to be on top of, to be able to discuss with our various clients as sort of time progresses. Because we had our first release, the amounts that they could apply for up until 30 June. We then had the second announcement, which was, or the second release, which was in theory to cut off 24th of September. So later this week was our early sort of cutoff for the second year applications, but that's been extended through till the 31st of December. And if you look at the stats, and APRA provide weekly stats on their funds, and I think the number is like 175 funds, APRA regulated funds have released superannuation benefits, but they received 3.2 million initial applications in that from clients. Now that's obviously for multiple accounts, so that's not saying 3.2 million individuals, but 3.2 million accounts were applied for. And we're approaching 1 million of those for the first time in this second financial year. So about 2.5 million in the first financial year. And then there's been 1.3 million repeat applications. So that obviously for me is the key one, and why I think talking about this concept of the third tranche is important for us, because there's 1.3 million people who, for whatever purposes, feel that they are still under some form of financial hardship and satisfy the criteria to get access to those benefits. So, you know, for us to say, well, that 1.3 million people will not need superannuation proceeds in the near future, it would really be sort of throwing the blinkers on and not looking at everything as it may occur. So I think we need to be ready to address all of those issues. So again, very briefly, we know that they either have to be unemployed or eligible, and therefore eligible to receive one of the various listed government income supports. The main one for me that I want to obviously highlight is Job Seeker. The Job Seeker numbers really were pretty interesting when they released the December to May stats from a Job Seeker point of view. The number of people on Job Seeker went from 800 odd thousand to 1.6 million. So we effectively, in that 6 month period, we saw a doubling up of the number of people accessing Job Seeker. Now that will hopefully start to come back, and unemployment numbers obviously went up, and there's been a little bit of a decrease, but I think we're going to get some fluctuation in that space over the coming 6 months potentially and longer. And so we need to be mindful of that. And I think one of the impact issues here is that we hear a lot about youth unemployment and how that number is quite high. But I think we're, particularly for our self-managed superannuation fund members, if we've got our clients that are near or past their preservation age and they've been laid off due to COVID-19, then we've got to contemplate their capacity for re-employment. And I think that becomes a bit of a critical issue for us, because to get job seeker, you know that they've re-established the mutual obligation requirements. So if anybody's applying for job seeker, they need to make sure that they show or can show that they are applying for their benefits. It's all well and good for a 58-year-old, a 59-year-old to declare retirement to access their superannuation benefits. But if they're doing that, then they're going to fail their mutual obligation requirements from a social security point of view and not be entitled to those government benefits. So, you know, we get into this awkward time frame, I think, in the post-COVID environment of how many people are struggling to become re-employed, and from an age demographic, what that actually means for some of our older clients. So yeah, so we've got the various requirements that people need to meet, your sole trader requirements with the reduction in of 20% more or more in their turnover. And of course, we're assessing against previous years. And so if we made the assessment in the first 6 months, then we need to go back and remake that assessment now. We can't just say, because we're entitled to it previously, we're still entitled. So if turnover has picked up, then clearly we need to make an assessment to see whether it's up or down by that 20%. And last time I was talking about COVID-19 to a group of people, I sort of provided the example of my sister actually is a massage therapist, and she, you know, had that the immediacy of losing clients from when COVID-19 came in. And so it was very easy to meet the 20% reduction in turnover. Well, now she's starting to see sort of clients come back to get massage, whatever it might be. But the issue with that is that there is still a lot of fear within the community, and people that are in those sorts of roles are probably struggling to get their full client base back, because people don't want to get into a closed room environment, whatever it might be, where there is more fear for spreading of the virus. So, you know, all those sorts of things are going to impact people's access. And a question we get asked a lot about, and we certainly addressed this in the very early days, as did the tax office, and that was the question of, can I take a lump sum under COVID and put it back in and claim a personal tax deduction? Now, the ATO, I thought, were pretty quick off the mark here to shut down that supposed strategy as soon as it was being promoted. So the whole concept of just taking the money out tax-free, putting it back in, claiming the personal tax deduction to get the $10,000 deduction. Well, the ATO have already commenced audit activity or review activity on 1,200 funds where the money was taken out and immediately put back into super. I mean, you know, if you want to wave the flag to the tax office, maybe next time ring them and say, look, I'm going to take the money out and put it straight back in and claim a tax deduction. So do you want to review what I'm doing? It's that whole thing of, you know, there's common sense that has to be applied in these sorts of circumstances. And at no point has the ATO sort of provided any indication that you cannot make contributions with this early release benefits. But the whole idea of taking out tax-free money, putting it back in to be able to claim a personal tax deduction where that was your only objective, then clearly that's against the intention of the law and the outcome of needing the money to provide for your financial needs due to COVID-19. So it is one of those areas that we need to be mindful of with regards to how we're operating in that space to ensure that our clients are doing the right thing. And so I want to touch on things, and I know Tom had a couple of questions there that have come from clients that I might throw to him in a moment, but I just wanted to touch on the illegal early release of super, because one thing that's gone a little bit unnoticed or unhighlighted over recent times is that our wonderful penalty units has gone up due to CPI from $210 to $222 for any breaches that occur post 1 July 2020. So if we've got any clients that are accessing their superannuation benefits after the 1st of July, I mean, if they did it before 1 July, then they've got the 210 penalty unit, but afterwards the liability is going to go up. And so if we look at the obvious administrative penalty, well, it's a breach of operating standards. So if the trustees pay a benefit out to somebody who's not entitled to receive a benefit, then that is a breach of the operating standards of the fund. That's subject to up to 20 units or penalty units, which is basically a $4,500 penalty after the 1st of July 2020. Now, the circle of debt occurs here because that liability is then imposed on the individual trustees or the corporate trustee, not on the superannuation fund. And so what we want to make sure we avoid is a situation where people then go and take that penalty out of the super fund, thereby taking further benefits and creating further breaches and further penalties. And so, it's really important to make sure that people do the right things. And our benefits are taxed as assessable income. So there's no tax concession. And I think this is a critical one. If you've got any clients or had anyone that's taken money out without that ATO approval, then that money will be assessed as normal assessable income, even if the money is put back into the superannuation fund. So you get the double whammy of not actually having the proceeds out of super. You then potentially have the admin penalties as well, but then a tax liability personally. So all of these triggers are what we need to be discussing with clients to make sure they do the right thing. And look, I chucked the sole purpose test in there because it is a worst case scenario, but ultimately if you've got clients with no regard for what the fund and its requirements are, then in the very worst case situation, you can have $500,000 worth of penalties imposed. Now, let's be realistic about that. For someone that accesses $10,000 super under early release without applying to the ATO, they're not going to be levied with maximum 5 years in prison and $5.5 or $500,000 worth of penalties. But it's a good time for us to be able to highlight these issues to our clients to get them to understand what their trustee responsibilities are as such. So I'm going to touch on some of those other early release issues in a moment. But Tom, have we had some questions from some clients in regards to early release that might be of value to others to hear?
Yeah, I've got a couple here, Tim. The first is, how quickly after receiving the release authority from the ATO should the fund or can the fund pay those benefits out to the members?
Yeah, look, that's a good question. I know I got asked that one at least once, and I think a few of you came and said, have you had this question, and we addressed it. But like the APRA funds, they got guidance from the tax office about the immediacy in which they needed to pay, and so there was like a 4-day turnaround that was placed on the APRA funds. And so I'd sort of said straight up that I think it's important for us to follow the lead. APRA have obviously got a lot more guidelines in place for their trustees because of the non-related nature. But I think in this sort of situation, it's important for the trustees of a self-managed super fund to follow on those same sort of principles that themselves as members are applying for this money, but they're doing so because they actually need it. And so, the super fund shouldn't be looking at, I need to sell down some assets or do whatever to pay some money out. They need to have that money paid out as quickly as possible. And so it all sort of becomes a little bit of a liquidity issue in the SMSF space. But ASAP and generally within a few days is what I would be saying. And again, if got clients in the next 6 months making the same applications, they should be applying that as well.
Well, just on those liquidity issues then, can the amounts be paid out by in specie transfer?
Yeah. Look, that's an interesting one, isn't it? I mean, we have dealt with the question about in specie transfers for many years, and normally it comes in the form of a pension question. So, can I make a pension payment via an in specie transfer? And the ATO response to that is, well, no, you can't. But the penalty for that is we're going to tell you don't do it again. It's one of those issues that it's a little bit problematic because the benefit has actually come out of the super fund. Now, again, I would ask the question back to the trustees, well, are you actually in financial hardship if paying out the shares is satisfying that liability, up to $10,000? Because, you still then have the need potentially to liquidate those shares to be able to actually meet your ongoing living expenses and things. So I think from an in specie point of view, whilst there's nothing that states that it must be a cash payment, I've certainly, when discussing it with others, I have addressed it and said, look, for all intents and purposes, it should be a cash payment. But that sort of leads us into, I guess, what I would consider tranche 3. And tranche 3 for me is really about other conditions of release that give us access to super. And I think we need to be cognizant of the fact that a lot of people are hurting at the moment, and they're hurting with regards to not only rents, but loan repayments and payment of mortgages. And we have a compassionate grounds condition of release that allows trustees to apply for superannuation proceeds to prevent the foreclosure or forced sale of the home. Now, what that actually means is they're going to need to get a statement from the mortgagee that they can provide to the tax office, who are charged with reviewing and assessing whether someone can access their super proceeds under compassionate grounds. But there is a capacity for people to access their super proceeds. So, that's one that hopefully we don't see too much of in the SMSF space, but it wouldn't surprise me if you see, funds coming along or situations arising where potentially people start to apply under this condition. And whilst it's a little bit of a segue into another section or another area of law, the government have just reintroduced the concept of the 6-member self-managed superannuation fund, and how many 6-member self-managed funds will spread the membership to younger members. And by spreading to younger members, we're sort of creating an environment where more people will have larger mortgages, more people will be under financial hardship as they come out of university and look for work and other things like that. So I think the expansion of the SMSF membership is one of those areas that will potentially lead us down a path of other conditions of release. And to me, probably the big one that needs to be addressed, and not just for SMSF members as such, but is severe financial hardship. And again, the key issue here is that the tax office aren't involved in this process. This is a trustee defined process. So if we've got any members, superannuation members, who can provide Commonwealth Department evidence that they've been in receipt of income support for 26 continuous weeks, then they can access up to or between $1,000 and $10,000. Now that amount of money is, firstly, it's an annual application, right? So people can apply every 12 months for that amount. But this 26 continuous week period is very relevant when we're talking about the current job seeker situation. I've got an example that I'll show up or throw up on the screen in a moment. But the $1,000 to $10,000 rule is for our clients who are under preservation age. Those who are over preservation age, well, they can access their superannuation proceeds if they have had a cumulative period of 39 weeks of receiving government income support after their preservation age. So this is not our 58-year-olds, because our 58-year-olds have only just hit preservation age. Our 58-year-olds, or those that are turning 58 now, they're only just hitting preservation age. So they're effectively 3/4 of a year away from potentially being able to apply for severe financial hardship. But those 57-year-olds who hit preservation age 12 months ago, they're at the stage now where they're well and truly in that area where they could potentially start to target the 39 cumulative weeks after turning 57, and then they don't have that $10,000 limit. So the condition of release does open it or exposes itself to those clients. Of course, they're going to be subject to the superannuation low rate cap if they've hit preservation age, so they can potentially access their benefits tax-free. But as I was alluding to before, accessing money under severe financial hardship for those at preservation may be more beneficial than starting a pension, because if they start the pension, then that will count from an asset test point of view for Social Security, which inevitably may lead to them being cut off JobKeeper or job seeker, sorry. So it's one of those things to be mindful of. But if I chuck up an example of both sort of age groups, we've got Michael who's 45 and commenced receiving job seeker in April 2020. Well, the 26 continuous weeks hits on the 30th September, right? So we're pretty close to a situation where if Michael is still in severe financial hardship because of other liabilities, and it might be mortgages, it might be other things that apply, he's applied for tranche number 1, that $10,000 has disappeared. He's applied for tranche number 2, that $10,000 has disappeared. Well, conceivably after the 30th of September, Michael can apply to himself as trustee of a self-managed super fund for up to a further $10,000. And I think it's that tranche that, whilst we need to have the conversation with our clients, you know, about what superannuation is for, we need to be mindful that there is that absolute issue, or the absolute issue associated with financial hardship, of what other impact is that having on people in the immediate future. And the purpose of super, whilst to provide for retirement, right, it shouldn't be to the detriment of every other element of their life as well. And I think that's a key issue, and I'll touch on that again in a moment. But that third payment is going to be assessable, and tax is going to be withheld at 22% on any sort of taxable component. So we need to be mindful of that. But if we look at Michelle's situation, well, Michelle is born in 1962, and so she's now age 58, just turned 58, but her preservation age was 57, so because it only changed to 58 for those born after the 30th of June 1962. So again, Michelle commenced receiving job seeker on the 1st of April. Then she could apply for the $10,000 under the same provisions that Michael has applied for post 30th September. She would get access to the low rate cap because she's hit her preservation age, and so the lump sum would be tax free on any taxable component. But she could also apply for, well, effectively her balance after the 30th of December, because once we hit 30 December, then she's triggered that 39-week period. Now, whilst that's considering that it's continuous and the requirement is only for a cumulative period, it does mean that Michelle, in this example, would be in that situation that she's got a first 6 months that she can apply, the second 6 months where she can apply for the $10,000, and a third period post that sort of 6 month, that second 6 month period, where she can actually apply for any amount of her superannuation over and above the lump sum. So I think financial hardship in that regard is fairly significant. But I wanted to touch on, and not focus too long because I want to get onto the rent relief stuff, but I just wanted to touch on where we sit with regards to the early release of super, because the government actually started doing a review of early release back in December 2017 and released a final paper in November 2018. And it touched on the whole definition of early release and a number of key considerations that people need to think about with regards to accessing super. And it made some proposals, and I think some of those proposals are very relevant in this current environment, particularly the one where they looked at introducing a new grounds of access to super under family and domestic violence. So clearly, as we know, in the current COVID-19 and the various lockdowns that have occurred around the country, one of the things that has been addressed quite regularly from a certainly in a media point of view, but the government have discussed it as well, is domestic violence. And so, you know, I see this federal budget as it approaches, and potentially the next budget in the next financial year, as areas where the government may very well, if they're not already doing something in the background, readdress some of these early release issues. But also, and what would be of assistance, is moving the existing early release from being a singular payment in a calendar year to being multiple payments that don't exceed a certain amount over a 24-month period. So there's that concept that they could potentially take up to 10,000 or whatever amount they potentially settle on, but as your needs arise, not as a lump sum, because there's always an issue that if someone takes money out, they're going to spend it. If they spend it, then that creates problems. But the four guiding principles to that is all about preservation. So the preservation of super for our retirement benefits. And of course, that is one of the key issues that we need to be mindful of. Measuring that versus actual hardship. So yes, superannuation is a preserved requirement. So super is there to provide for our retirement benefits in accordance with the sole purpose test, but that hardship and the needs of now can often outweigh the future needs of the individual. And so that should be taken into consideration under any sort of potential move in this early release area. Super as a last resort, again, or you accessing super as a last resort is a key area that these documents and these reviews have considered. And that is, I guess, one of the principal issues that we've been discussing under the COVID-19 stuff is whether or not we should be encouraging our clients to access money from other ways or in other means before they start to access their superannuation. And I think that that's always going to come down to personal circumstances. And then finally is that it's all a fair and effective process. And I think this is one of the key issues, and it touches on that last point as well. And that is that the ATO, the whole review process is that the ATO will take on responsibility for financial hardship like they currently do for compassionate grounds. And then it takes it away from the trustees having to make decisions based on other information. So, you know, I think we've seen from the way that that COVID-19 has worked, the ATO's response rate has been pretty quick with regards to access of super. And so I think that will probably push through a process where the ATO are having access. So I want to move on and focus the second half of the presentation onto the financial assistance. I just want to make sure, firstly, have we had any other questions, Tom, on anything?
The only other question I've got here, Tim, is what if someone actually took money out of their self-managed fund without applying for the release from the ATO?
Yeah, good question. What if they take the money out without applying? So, look, I guess the first thing I would be suggesting to those clients is you've got two things that you need to address. And one of them I'll be touching on a little bit with the rent relief as well. And that is that the best course of action for SMSF trustees is voluntary disclosure, right? So if you take the money out of the super fund and you weren't meant to, which means the trustees have paid it out and they weren't meant to, then you should be disclosing that to the tax office to minimise the risk of any penalties being imposed. I would think that the other thing they should do is apply to the ATO under the personal, under MyGov to get the determination, right, to be able to satisfy the conditions so that from a voluntary disclosure point of view, they can then go and say, okay, we took the money out, but we then applied and the ATO gave us the capacity to do it. And then the ATO, I guess, from an administrative point of view, may look at that and go, okay, well, you know, there was a process, you should have followed that process, right? We're not going to impose any penalties here, and don't do it again, which of course, in theory, they can't do it again anyhow. But I think it's a matter of trying to make them or push them towards the right process to get it tidied up before that fund goes to audit, because you can guarantee that even if it's, you know, an issue that the auditors, if it's a minimum amount or whatever, the auditors might not raise it, but you can guarantee that the ATO are reviewing these release authorities, and when they come and see a fund where the benefits are being paid out and there's nothing else to satisfy that come audit time, then you can see potentially some issues arising there. So touching on the financial assistance and really heading into the rent relief area and the key issues associated with rental relief, I think what we need to address is that there's really three things that stem from rent relief, and that's liquidity for the fund's point of view. So it has an ongoing impact on potentially the liability for a fund to pay its pension. There is the obvious financial assistance side of things, which is, you know, are you providing financial assistance to a relative or a member by reducing the rent, and how have you arrived at that decision to provide that financial assistance? And then the third thing is, what other implications, so whether they be in-house asset or other sort of investment restrictions, are you creating by offering the rent relief? Because again, if that rental income is a requirement for you to be able to satisfy any LRBA payments, then you're going to have compliance or potential compliance issues with regards to how the fund meets its liabilities. So again, one of the dot points, or one of the points that I raise in a slide about financial assistance in a moment, we'll touch on very briefly non-arm's length income and non-arm's length expenses. And I'll expand a lot on that in the paper, because Effectively, we've got a situation where if we are dealing with rent relief on a case-by-case scenario, and if we are being fairly thorough in the way that we apply it and documenting it appropriately and following the guidelines as set down by the mandatory code of conduct, then we're not going to find ourselves in situations where non-arm's length expenses and non-arm's length income sort of jump out at us and take the fund by surprise. But if we are ignoring, if we're ignoring all of the requirements of the government, if we're ignoring the communications that's coming from the ATO, and we are just applying relief for the sake of applying relief, and it's not necessarily an entitlement, then we can find our self-managed super funds not entitled to any of these exemptions and extensions for in-house asset rules, and they could be whacked with non-arm's length income requirements almost immediately. And I think that's one of the issues that we need to be mindful of. And even if it's things like valuations, I mean, I came across one the other day where the fund is looking to consider selling an asset. And because some of the members are looking to move out of the fund, and ideally they're saying, well, should we look at bringing the valuation down, subject to the fact that they've more recently got an independent valuation, but the trustees are contemplating whether to reduce the value of the asset, because then it'll make it easier for the business or other associates to buy into the property. It's like, well, okay, well, once you start looking at reducing things to make things easier for members and relatives, then you're starting to really jump into non-arm's length income areas, and the ramifications for that from a super fund point of view, 45% is not an area that any of us want to be addressing for our clients. So again, case by case, we should be looking at the National Cabinet Code of Conducts. And again, in the paper, I've got the full code of conduct in there just as a bit of a refresher for you. Our rent relief, it should be short term. Hopefully it's short term, and I guess depending on which states you're in, things might be operating or getting close to operating at full capacity again. But again, for the purposes of location, there are certainly going to be some industries and some locations such as Melbourne Central, where it's going to take a little bit longer. And so we need to be reviewing any existing rental agreements we've got in place and working out what relief is required and how long that relief is required for. And I think that's the how long is a piece of string question, is that the code of conduct talks about a suitable recovery period. And so we need to know what that recovery period will be, but also that rent relief actually does have a long-term impact. And the long-term impact is, what deferrals have we put in place? How are we recording those deferrals? How are we collecting that deferral? And is the fund continuing to do the right thing once we get out of what I call the COVID period, which is 30 June 2021, from a point of view of that's where the ATO's focus is now, is that they're providing all this relief until the end of 2021, but clearly all these issues are going to move across into to further sort of timeframes. So there's the overarching principles that were put in the code of conduct, and I think this is an interesting one. It's interesting in the sense that I've already seen funds not follow this, and so if they're not following this, it's going to create a problem for them operationally moving forward. But there's a common interest between the tenants and the landlords to resume normal activity. Now that common interest is going to be, again, potentially stymied by such things as what's occurring in Victoria, but we don't know when, or potentially if second waves come in and as international travel opens up again. We just have to look to Europe now, where that second wave is coming, as is winter. So COVID-19 sort of started tacked onto the end of their last winter, but they're now approaching the end of summer and the start of winter again, and we're seeing second waves. And if we're looking at opening up travel and airlines in the new calendar year, what impact does that have on the states where most people are traveling to? And will that then force the states back into some form of lockdown? And, we obviously don't want to have this continual cycle of people going in and out of lockdown or restricted trading. And so we do want to resume normal activities, but it may be out of our control in some instances. It's got to be mutually satisfactory. And again, I think when dealing with related parties, that's always going to be a little bit easier to get that mutual satisfaction, but not in every set of circumstances. Good faith, so we're negotiating in good faith and acting in an open and honest manner. Now, I think the key, probably the most critical thing of the overarching principles, was that the arrangement needed to be proportionate and appropriate and inclusive of that recovery period. So proportionate means, if you saw a 50% reduction in your rental income, in your turnover, then any rent reduction should be reflective of that 50% reduction in turnover. So it's all got to be linked back to the struggles of the business, because clearly some industries have not been impacted at all by COVID-19 and it's business as usual. And so there should be no need for rent relief to be provided in those circumstances. And I think they're the areas that our fund auditors are going to focus on. And I think this is a key one, that landlords must not terminate leases due to non-payment. Now, what's important is that these mandatory code of conducts were introduced subject to the states introducing their own legislation around evictions and other things as well. And many of those eviction restrictions effectively were ceasing, again, around about this week, next week, so end of September. But a lot of the states have actually extended their legislation. So what we've done, and we'll send it through as part of the package afterwards, is we've actually put together a bit of a table that references both the commercial and residential rent relief and where you can visit each state to determine what sort of relief is potentially available. So I think that's a key issue to be mindful of. Obviously, there is a commitment to the lease, but the proportionate reduction, as I said before, it's got to be, or can be, a combination of a waiver and a deferral. And based on the code of conduct, the waiver constituting no less than 50% of the reduction, unless you negotiate otherwise. So again, it's coming down to what those negotiation points are and well and truly documenting it. The key one, and I guess this is why I talk about the extension period going beyond 30 June 2021 and potentially up to the 2023 financial year, is that the deferrals must be effectively spread out over the term of the lease for a period no less than 24 months. So we have to make sure that we're seeing those rental payments continue on, or those increased rental payments continue on and covering up over that 24-month period. Now, what we're going to see in that situation is a lot of funds where they're not paying any of that rent at the moment. It is sitting there as a liability for the tenant to pay to the super fund. So it's an asset to the fund. And obviously we want to make sure that that is a continually diminishing asset over time, because there's an in-house asset exemption that I'm going to touch on in a moment, but it's effectively a timed exemption, and we don't know what approach the ATO are going to take beyond 2021 with regards to exempting those deferrals from the existing in-house asset rule. So we do need to address that issue as a bit of a question moving forward for our clients. So from a documentation point of view, what we want to see, and look, a lot of the document providers out there have come to the party here and have provided this supporting material for clients to use. I know for those of our clients, we can help prepare this documentation if the clients haven't already done something themselves. But you want to see a request. So you want to see the tenant requesting the relief, and you want to see some form of evidence. And that's probably, I'm not sure if you would support this, Tom, but that's probably one of the things that I've seen there be a lot of issues is you see the rent not coming in or a lower amount, but there's nothing else. Would that be a common issue that you've come across?
Yeah, I think that's a fair point, Tim. And that's as we come towards the preparing financial statements now for 2020, it's what documentation do the auditors want to see where that's happened, where there's just been a cut off of the rent, and it's generally where you're a related party with the commercial business being rented from the super fund. So that's probably the question that we need to answer.
Yeah, look, and it's it's always hard again, whenever we're dealing with ourselves in a related sense. I mean, I know, I prepare my own self-managed super fund financials each year, and it's always like, I'll get to writing that minute, I'll get to preparing those sorts of things. And so it's not always a matter of that somebody hasn't done the relief or that somebody hasn't requested the relief, but they may not necessarily have documented it. So they want to show that decision process has occurred, and how they've agreed with that final position. And I think that's the whole negotiation thing that needs to be taken into consideration. But look, and I guess that's where we're going to have funds that come into some issues, is those funds that haven't actually sought to negotiate. That's going to be where we'll come across some concerns, I suspect, from the auditors, and we'll probably have to address those on a case-by-case basis. So that's one of the things to take into consideration. That will obviously result in the decision of the trustee being included, and also the terms. So any terms that are associated with what the review and the relief actually looks like. So again, you'll see some property lawyers getting involved in these conversations a little bit as well, and they'll talk about, and the ATO have even highlighted this, that it is preferable to see amendments to the lease. Just as an off-the-cuff comment, have you seen any of your clients, Tom, actually provide amended leases, or more just request documents in this instance?
Just request documents at this stage. We probably haven't seen too many come through as yet, but it's generally that request, and there's some sort of minute or some sort of follow-up document to say that, these are the new terms we've agreed to, but no change to the actual lease as such.
Yeah, okay. And look, and I think, from the outset that the ATO didn't say it was mandatory, so it's one of those areas. So I think it's really just an assessment of what the clients are actually provided. And again, how long it's applicable for and what review periods. And I think the review periods is probably the critical point now for our clients, is that we're 6 months in, and so this is probably the first real review period, because that's when most of the cutoff points were occurring, which is, I guess, again, part of why we did the presentation now, is because everyone sort of said, okay, well, here's the rent relief, give everybody 6 months to sort of see how things are tracking, and then to make sure that we're actually starting our review after that point in time. So, end of September is really that first key point, and we need to start addressing it for the clients. And, the idea that the ATO won't take compliance action is a nice thing to have in the back of your mind, but it's not a guarantee. The ATO aren't going to say, okay, well, because you provided rent relief, we're not going to look at your funds, because the ATO know as well as everybody that there are trustees that will do everything to not do the right thing. Now, hopefully that doesn't apply to any of the clients for anyone on board with the presentation today, but certainly I know from some of the examples that I've been dealing with, you do have, let's call them rogue trustees, who tend not to operate under the best set of circumstances. So one of the things, and I want to talk a little bit about this in-house asset exemption to sort of give some clarity around what it might look like from a financial accounts point of view, and again provide some examples in the supplementary paper. But we've traditionally got our properties in self-managed super funds held one of two ways, but then there is an extension of that, and that is that they're held directly, which is probably the most common way that self-managed super funds hold their property, and then through some form of interposed entity. So we've got our Div 13.3A, 13.22C trusts and companies. Now, generally, it's important to understand that in those set of circumstances, that it's paramount that the super fund operates and deals with the related parties absolutely on commercial terms. But if you look at Division 13.3A, which is the 13.22C unit trusts and companies, the provisions aren't necessarily just talking about related parties. So when you talk about the income of a 13.22C trust, it talks about that all transactions are dealt with on a commercial basis, on arm's length basis. So it's not talking about all transactions with a related party. It's talking about all transactions. So, when we start to look at this rent relief, we still have to make sure that even if we're dealing with non-related parties, that we're doing the right thing. And so what the tax office have done is they've actually released this document, SPR 2020 D2, which is an exemption to the in-house asset rules for rent deferrals. Now, let me just repeat that, rent deferrals, because rent waivers are a little bit different, but rent deferrals is actually a liability to the tenant. So the tenant has this obligation to pay that amount. And if for a directly held property, that tenant is a related party, then the provision of the deferral is, for all intents and purposes, a loan, right? So there's 20 years of history from the regulator that says, you know, accommodating late payments or non-payments, and it initially started being about trust distributions and things like that. But if you are effectively giving your relatives, your related parties, conditions that you wouldn't give to others, then that's deemed to be financial assistance and conceivably a loan. So that would generally be an in-house asset, right? So this exemption, this document provides an exemption to that, to say if there is a rent deferral, then it won't be an in-house asset for the 1920 and 2021 year. Nothing beyond that, so we need to be mindful there. The interposed entity, the 1322C unit trust and company, because it's not necessarily about related parties, it's talking about all transactions must be on an arm's length basis, but also that you can't have any financial provision to any party, so the unit trust cannot lend. Then it doesn't matter if that party is related or not. If you've got a 1322C entity holding it, then you're getting this in-house asset exemption, because otherwise you're going to have to wind up the entire trust. And this is the issue between directly held and interposed entities. If you directly hold the property, then the loan is the in-house asset. And so you've got a fairly small in-house asset issue there. Whereas if you breach the 1322D scenarios and situations, i.e. you provide credit to the other parties, then you're actually breaching the entire unit trust. And so you're incorporating the value of the property in that transaction. And that's dire. I mean, that's as dire a consequence as you can get in that situation. So you really do need to be mindful. But what about other trusts? Pre-1999 unit trusts are an area that we need to be mindful of, because there's no relief provided under the conditions. Now, is that just because it wasn't thought through in its entirety? Will it be in the final document, given that it's still a draft? You know, there's a little bit of uncertainty there. And, you know, a lot of people will throw away and say, oh, pre-99 unit trusts can do whatever they want. Well, no, they can't. They still have to act commercially and transact commercially. So I think by applying the same principles to a pre-99 trust, you would assume that there would be an in-house asset exemption, but there's certainly nothing stated that that's going to be the case at this situation or at this point in time. So it kind of leads to two real trigger points, or two trigger issues for me. And that is, what if the parties aren't cooperative? And then what if there are borrowings associated with it? And I'm going to come back and finish on the in-house asset side of things in a moment. But I just wanted to touch on that, what if parties aren't cooperative? So we had a client recently, and we're talking about a couple of trustees who aren't related, so business associates inside the same self-managed superannuation fund. But you may come across a situation too where you've got separated couples and they hold property in the fund, and they're going through asset splits at the moment, and one of the assets may actually be a property inside the fund. But in the situation that I was dealing with, you had unrelated parties, business premises, the business premises leased to one of the parties. Now they're trying to separate their interest in the fund, and that party just stopped paying rent to the superannuation fund. Now the other party is trying to get some form of satisfactory answer from the non-paying or non-communicative trustee, and they're sort of throwing their hands in the air to say, well, what do we do? Because our fund is in effect breaching the requirements. We've got arm's length issues. We've potentially got therefore larger tax liabilities. And so what I actually did in that set of circumstances was I contacted the ATO, and look, we could say what we want in regards to some of the things and ways that the ATO operate, but their SMSF voluntary disclosure process to me is a really good situation or good opportunity for SMSF trustees who are trying to do the right thing. And so I spent a little bit of time on the phone to the tax office, and they said, look, the best thing they can do is if the trustee who's trying to do the right thing gets in contact with them, then they can at least start to communicate with the non-complying trustee and firmly reiterate what their obligations and requirements are. But also what it does is it gives a little bit of, I guess, comfort to those trying to do the right thing, that if they've been upfront with the tax office and if penalties are potentially to be imposed, then the ATO have the power to impose them on those sort of troubling or troubled trustees that are doing the wrong thing. Now, that's not to suggest that every situation is going to go to the ATO and hopefully people can negotiate and get matters solved otherwise. But I think voluntary disclosure, particularly in the current environment, is an area that is worthwhile for trustees to head down. And I know that we've used it a number of times for a number of different purposes, and the ATO have always been very accommodating of the clients. I think we had one situation, Tom, where we had a client who was bankrupt and kind of forgot to resign as trustee. I'm not sure how you forget to resign as trustee, but they then recognised that they should have, and just at the same time they were discharged from their bankruptcy, and so they applied to the ATO under voluntary disclosure to say that this is what we should have done. Do we need to resign? And the ATO said, no, you're okay. You're outside that 3-year period. Is that correct? Do we have a situation like that?
Yeah, I think you're always best when you jump on the front foot and say, hey, look, put your hand up. We've made a mistake. We've either fixed it or let us know what the best way to fix it is. And generally, you get a pretty good response.
Yeah, cool. That's really good. And so I think we need to make sure that we're all being cooperative there. So then, with regards to borrowings, I think one of the situations that I would be mindful of is that limited recourse borrowing arrangements are going to come under 2 categories. You've got your commercial lenders, and then you've got your related party lenders. And if you've got your commercial lenders, well, we know from the Banking Association that they gave an initial 3 months for loan repayment deferral with a possibility to defer another 3 months. Now that 6-month period has effectively come to an end, and they've given a further 4 months, as long as you go directly to your banks to ask for that potential. Now, a potential to continue to defer. Now, not all banks operate under the Banking Association guidelines, and so it may need to be on a needs and negotiation basis with the particular bank. But what it does lead to is related party loans and what that means for self-managed superannuation funds. And I think the key here is obviously our Practical Compliance Guidelines 2016-5, and what that means with regards to self-managed super funds. Now, the key to an LRBA, and I think this is where we're going to see a lot of problems, I suspect, in the LRBA environment, more than usual over the next sort of 12 to 18, 24 months. And that is that if rental incomes continue to be lower and funds continue to struggle to meet their LRBA obligations, well, if they've applied for that loan under the PCG terms, under the Practical Compliance Guidelines, then they are restricted to a 15-year term. So that 15-year term is reflective of how many years they've already had it for, and then how many years it's remaining. So if they are getting a deferral of their repayments, one, they have to be capitalising the interest. So interest is still payable and needs to be represented in the financial accounts, but their payments are going to increase significantly for that remaining term. So even if they refinance, you can only refinance under PCG 2016 and do it with whatever term is remaining. So I think we're going to see a lot of issues from an LRBA point of view with regards to these related party loans for properties inside self-managed super funds. So I think that's an area to watch this space. Again, as I said, it's something that I've touched on in the supplementary paper to give a few examples for, but we just need to be mindful that if clients particularly have done related party loans and they haven't followed the PCG, then there's absolutely no guarantee from the ATO that the ATO won't be reviewing the fund the borrowing arrangement. And again, when we're talking about non-arm's length income and non-arm's length expenses, it's pretty critical with regards to LRBAs that we're not creating effectively a non-arm's length transaction for the fund. So again, as I wanted to point out to you, and I'm not going to read through all these word for word, but financial assistance obviously covers off on a lot of areas. And if we touch on a couple of issues, they're releasing a member or relative from a financial obligation owed to the self-managed super fund, including where the amount's not yet due and payable. So this is where COVID-19 and rent relief, fits well and truly under that financial assistance. If we're leasing it to a member of the fund, right, and not to another related entity, a company or a trust, then are we releasing that of that obligation? Is that what a waiver is actually doing? And so we need to be able to show that any waiver is done in accordance with the code of conduct to make sure we're not coming up against any Section 65 issues. Again, similarly to if we're looking to buy and sell assets, that we're making sure that we deal on an arm's length basis. So again, I just wanted to highlight those key points because it's pretty critical for all of our clients. So from an existing in-house asset point, just to sort of wrap up the related party transactions there. If you've got clients with existing in-house assets and they were under or over the 5% last year, what have they been able to address that and fix that this year, or have they put their plans in place? And has COVID-19 impacted it? Because if COVID-19 has impacted their capacity to repay or get back below under 5%, then there's effectively a little bit of grace from the regulator in that regard. But what about if they satisfied the requirements previously and now fail the 5% test? What's critical is that those funds still put their plan in place now as to how they're going to get out or get through the in-house asset issue by 30 June 2021. If markets haven't recovered, if COVID-19 is still hugely relevant in creating financial assistance, then not following through on that plan is not problematic, but not having a plan is a problem. So we need to make sure that we are addressing all of our funds that maybe have a loan to a related company, that we invest in related companies where the valuations overly priced, for example, and everything else has come down. We need to be mindful of how those situations operate. So last slide really for me to touch on and finish up today is pension considerations. So in our previous webinar, and we can certainly provide access, I know a lot of you attended that webinar as well, we touched on the area of taking lump sums versus pension payments, commutations and all those sorts of things as a result of the 50% reduction. But what I guess I wanted to address in a very sort of question-based way is, should we be considering commuting our pensions? So you've got the situation where a lot of people have pensions for the exempt current pension income deduction that they obtain. But in this current environment, what is that benefit? What is with a lot of companies not paying dividends or reducing their dividends, the tax liability of the fund potentially is going to be lower. But, is it actually about capital preservation? If they're trying to preserve capital, are they better off either reducing their pension or stopping their pension entirely? But if they are looking at stopping their pension entirely, then what does that mean if they've got multiple pensions? So if they've got multiple pensions, how is that going to disrupt their estate planning? If they had tax-free and taxable pensions that they wish to push to other family members or whatever it might be. So when we're weighing up the tax versus capital preservation, yes, we've got to look at what is the impact of having the exempt current pension income deduction, but also what are the other obligations or other problems that are created by the situation. And of course, if these clients have got grandfathered pensions from an age pension point of view, then we want to make sure that they are maintained, unless their assets have dropped to such a significant level that the new asset and deeming test is not going to impact them so much. But clearly our grandfathering issue is one to be mindful of. And we've got a couple of fact sheets actually coming up with some potential government announcements out shortly about the age pension as to how grandfathering rules are impacting social security benefits at this stage. So keep an eye out for those documents in the coming weeks. So look, what I wanted to really finish with is how many of your clients are impacted by COVID, either financially, via financial hardship externally, or via the fund liquidity? And again, the number of times I've been asked questions about investment strategies in the last few months, it's clearly a document that, you know, I probably paid as much lip service as anybody to investment strategies for the first 15 years of self-managed super funds. But how on the ball with the ATO to come out to everybody, or to 18,000 funds last year, and say, hey, is your fund diversified enough? How many of those 18,000 funds are now facing problems because they can't meet their loan repayments? So, you know, it's pretty critical that we do address these particular issues with our clients. And then what processes have we put in place to review our clients' circumstances sort of 6 months from now and 12 months from now? Because whilst COVID-19 may, and we hope, dissipates with regards to the spread of it, the financial implications of it for self-managed super funds and beyond won't disappear at the same time, and we need to be mindful of that. So if anyone's got any questions, please shoot them through, and Tom and I can address them for you. What you'll receive from us, as I said, is a CPD certificate, so that'll follow this week. The paper, I've put together the paper, which will expand on, because I want to incorporate a lot of more examples and live cases into these presentations, but also we'll be releasing some workshops in the near future from an education offering point of view as well, where we get into the nitty-gritty of things. But for the purposes of today, it was really about information overload, and then being able to take that information on board and see what that means from your client's point of view. You'll get a copy of the slides, so you can have a refresh of how that links into the presentation, and any questions and answers. So there's been a few questions that we've brought into this from the clients, or from our clients so far, and we'll provide those as part of the paperwork. And then finally, look, we do appreciate the feedback that we get on the presentations. It's always good to hear what people are thinking, and even what subjects they might be interested in hearing about. So please don't be shy in giving any feedback. Everything is appreciated. And unless we've got any questions coming through, that will probably be it for the day. So thank you very much for attending, and we'll be in touch with you soon.
Thanks all.